Since 1971, the US dollar has lost more than 85% of its purchasing power. Not 10%, not 30%, 85%. A $1 bill from 1971 now buys the equivalent of roughly 14 cents worth of goods today, according to the US government's own inflation data. That is not a forecast. That is a measured reality. And in 2025, for the first time in half a century, there is evidence that the rest of the world is beginning to recognize it as well. In the first half of 2025, the US dollar index, the DXY, fell by more than 10%. That was its largest decline since 1973, the year of the OPEC oil shock. The dollar's share of global foreign exchange reserves has fallen from 71% in 1999 to 57% in 2024, according to the IMF's COFER data. And central banks around the world purchased 850 tons of gold in 2026 alone. What is happening? And what does it mean for your investment portfolio?
To understand what is happening today, we have to go back to 1973, the OPEC oil crisis.
Oil prices quadrupled in less than a year. The global economy was shaken. In that context, the United States and Saudi Arabia reached an arrangement that was never fully formalized in public, but it reshaped the global financial order for the next 50 years. Saudi Arabia agreed that oil would be priced in US dollars. In return, the United States committed to Saudi Arabia's security and became its principal supplier of military equipment. This was the Petrodollar system. This system had one extremely important consequence. If every country in the world needed dollars to buy oil, then every country in the world needed to hold dollars in its foreign exchange reserves. Demand for the dollar became structural, not dependent on US economic performance, not dependent on interest rates, and not dependent on trade surpluses. And sustained demand for US Treasuries meant Washington could borrow at lower interest rates than almost any other country in the world, indefinitely. Barry Eichengreen, professor of economics at UC Berkeley, called this America's exorbitant privilege. That privilege is now being challenged. And this time, the challenge is backed by data, not theory.
But before we examine what is changing, we need to establish one crucial fact that many financial videos overlook. This system is not being shaken simply because some countries dislike the dollar. It is being shaken because Washington has used the dollar as a weapon, twice, and the rest of the world has noticed. The first force, the weaponization of the dollar. In 2022, after Russia invaded Ukraine, the United States and its allies froze nearly $300 billion in reserve assets held by Russia's central bank. This was the first time in modern history that a major nuclear power had effectively been cut off from its own foreign exchange reserves. Russia's response was expected, but the reaction from other countries, India, Brazil, Saudi Arabia, the UAE, and even some US allies, was what mattered. A senior reserve manager at a Southeast Asian central bank told Reuters in 2023, "If it can happen to Russia, it can happen to us. That is why we are diversifying." The message does not need decoding. The US dollar is safe, but only if you remain aligned with Washington. And in an increasingly fragmented geopolitical environment, no country can be certain where it will stand 10 years from now. The second force, the 2025 tariff shock and the repricing of trust. In April 2025, the Trump administration announced a reciprocal tariff package targeting more than 60 countries. The market reaction was immediate and unambiguous. The dollar fell 5% in less than 2 weeks.
But the more interesting part was not that the dollar fell. The more interesting part was this. US Treasuries, the asset that usually rallies during periods of stress, also sold off at the same time. In modern financial history, that is a rare configuration. Normally, investors sell equities and buy treasuries when a crisis hits. When both decline together, it signals that something more fundamental may be taking place. A February 2026 Brookings Institution report described this as a breakdown in confidence in U.S. fiscal management, not a wholesale exit from the dollar, but a serious reassessment of Washington's long-term debt trajectory. The third force, cracks in the petrodollar system. This is the most important development as of early 2026. According to Bloomberg data and a March 2026 report, Indian refiners are settling Russian crude purchases in Chinese yuan and UAE dirham, bypassing the dollar system entirely. More importantly, Iran has begun collecting transit fees in yuan from oil tankers passing through the Strait of Hormuz, the route through which nearly 20% of global oil supply flows. The cost per voyage? Roughly $2 million, paid in yuan. If this continues, it is not merely politics. It is the mechanical restructuring of global oil trade. And that is something the 1973 petrodollar system has never had to confront. At the same time, alternative payment infrastructure is being built faster than many people realize. The mBridge platform, built on central bank digital currencies, or CBDCs, has processed payments equivalent to 387 billion yuan, or $55 billion, with 95% of transactions denominated in yuan. Saudi Arabia, the heart of the petrodollar system, joined mBridge as a full participant in June 2024. And China's CIPS system, Beijing's alternative to SWIFT, processed the equivalent of $245 trillion in yuan-denominated transactions in 2025. This is no longer a design on paper. This is real infrastructure, already operating, already moving real money.
Now comes the part that most de-dollarization videos do not say clearly. The US dollar is not going to collapse. Not this decade. Possibly not this century. And here is the data-driven reason why. According to the 2025 Triennial Survey from the Bank for International Settlements, the BIS, often described as the central bank for central banks, the US dollar is on one side of 89.2% of all global foreign exchange transactions. That figure is actually up from 88.4% in 2022. On top of that, roughly $14 trillion in dollar-denominated credit is circulating outside the United States. Companies, governments, and banks around the world have borrowed in dollars, and they must repay in dollars. That is not an exposure they can unwind overnight. The Brookings Institution, one of Washington's most influential policy think tanks, published an analysis in February 2026 with a notable conclusion. Global central bank reserve managers are not exiting the dollar, largely because there is still no sufficiently credible alternative. The Chinese yuan accounts for only 2.12% of global reserves, even though China is the world's second largest economy. The reason is capital controls. You cannot freely reserve the yuan if you cannot freely convert it. Meera Chandan, co-head of global FX strategy at JP Morgan, put it plainly. The dollar's dominance remains enormous. The gap with the euro, the second largest reserve currency at around 20%, is even larger in actual markets.
Based on the Q3 data,
Analysts at ING have offered one of the most widely cited forecasts in this field. This will be a decade-long transition toward a multipolar currency world, where the dollar, the euro, and the yuan could become the dominant currencies in the Americas, Europe,
and Asia, respectively. A multi-currency world, not a world without the dollar. That distinction matters more than any headline you will read about the death of the dollar. But, and this is the important point, a currency does not need to collapse to inflict real losses on those who hold it. It only needs to lose status. So, who benefits and who gets hurt? Start with the most obvious loser. First, the US government. Exorbitant privilege has allowed Washington to borrow at unusually low interest rates for decades. If demand for US Treasuries declines, yields must rise to attract investors. And with public debt now around $39 trillion, every 1 percentage point increase in borrowing costs adds hundreds of billions of dollars in annual interest expense. The Congressional Budget Office, the CBO, has projected persistently rising deficits and a deteriorating debt trajectory over the coming decade. That is not sustainable if foreign investors no longer buy treasuries automatically. The second affected group, U.S. multinational corporations. U.S. companies with substantial overseas revenue, Apple, Microsoft, Alphabet, face margin pressure when foreign currency revenue translates back into fewer dollars. Conversely, exporters from non-U.S. economies benefit. When the dollar weakens, their products become relatively cheaper when sold into the U.S. market. We already saw this in the trade data. After the DXY fell 10% in the first half of 2025, Germany and Japan recorded significant increases in their trade surpluses. The clearest beneficiaries in an emerging multipolar world, emerging market economies with external debt denominated in US dollars. When the dollar weakens, their debt burden, priced in dollars but serviced in local currency, falls proportionally. That is very good news for Brazil, Turkey, and many Southeast Asian economies. And of course, gold investors. Since the acceleration of the de-dollarization trend, gold has risen from $1,800 to $3,620 per ounce as of September 2025, an all-time high. That is not coincidence. Central banks are buying gold as a reserve diversification tool that does not require choosing another competing currency.
Based on data from Morgan Stanley, JP Morgan, and the Brookings Institution,
there are 3 reasonable scenarios for the US dollar from 2026 to 2030.
Scenario 1. Slow and managed erosion. This is the base case for most reputable research institutions. The dollar continues to lose reserve market share, declining by another 5 to 8 percentage points over the next decade. A multi-currency system forms gradually. There is no major dislocation. The world adapts. Probability. Morgan Stanley assigns this scenario the highest likelihood, roughly 55% to 60%. Scenario 2. Acceleration triggered by an external shock. This is the more concerning scenario, and it is not impossible. If a debt ceiling crisis, a sovereign credit downgrade, or a major policy error leads foreign investors to demand materially higher yields to hold U.S. Treasuries, the dollar's decline could compress from decades into just a few years. DollarCollapse.com, not a mainstream source, but one that uses accurate data, argues that a slow decline can become a rapid decline. This is what happened to sterling after World War II. The British pound lost its reserve currency status over roughly 15 years after the United Kingdom emerged from World War II financially exhausted. That is the closest historical precedent we have. Probability for the acceleration scenario. JP Morgan estimates 20% to 25% over the next decade. Scenario 3. Status quo plus. This is the most optimistic scenario. The dollar continues to dominate because there is no true rival.
The yuan cannot fully rise because of capital controls. BRICS has no common currency. Russia confirmed in January 2026 that discussions over a shared BRICS currency have not taken place and are not taking place. In this scenario, de-dollarization remains a marginal trend, a form of marginalization, rather than a true structural shift. Probability. Brookings places this at roughly 15% to 20%. The problem is that even in the most optimistic scenario, the erosion of the dollar's privilege continues. The speed is the only thing still being debated. So, as an individual investor, what should you do with all of this information? The honest answer? Do not overreact, but do not ignore it either.
Here are 5 specific steps based on what institutional allocators themselves are doing. Step 1. Add real assets to your portfolio. Gold, silver, and real estate have survived every monetary crisis in recorded history. They cannot be printed, cannot be debased, and cannot be frozen. You do not necessarily need to buy physical gold. Gold ETFs, such as GLD or IAU, are sufficient for most individual investors. A reasonable allocation? 5% to 10% of the portfolio. Step 2. Diversify into international equities. If the dollar continues to weaken over the long run, shares of non-US companies, denominated in euros, yen, or Swiss francs, will appreciate when translated back into dollars. International equity ETFs, such as VXUS or EFA, are simple starting points. Step 3. Lock in fixed-rate borrowing before it is too late. If further dollar weakness forces the Federal Reserve to defend the currency by raising rates, floating-rate borrowers will be hit hardest. Fixed-rate debt is the cheapest insurance you can buy today. Conversely, do not rush to repay existing low fixed-rate debt. In an environment of dollar depreciation and persistent inflation, a 3% fixed-rate loan may become one of the best financial trades you ever made. Step 4. Reduce dependence on dollar-only assets. Not abandon, rebalance. A savings account in another currency, international bonds, or simply ensuring that your portfolio is not 100% dependent on a single monetary system. Step 5. Continue dollar-cost averaging into index funds. That may sound contradictory after everything we have just discussed, but it is not. The S&P 500 is not the dollar. It represents ownership in companies with global revenue streams. Even in a weaker dollar scenario, companies within the S&P 500 can adjust prices and revenues accordingly. History shows that equities are a better hedge than bonds against inflation and currency debasement. The real question is not, when will the dollar collapse? The real question is, are you preparing for a world with less dollar dominance, or are you still behaving as if 1971 never happened? The previous generation lived through the British pound losing its reserve currency status. It took roughly 15 years. There was no single decisive moment, just a gradual drift, and then one day, the world looked back and realized the order had changed. We may be halfway through a similar process, or we may not have truly begun it yet. Nobody knows for certain, and anyone who claims they do is probably selling you something. What we do know is this: the trend is real, the data is real, and preparation, not panic, but disciplined preparation, is the only rational response. If this video was useful, subscribe. Every week, I break down real economic data,
Not predictions, not doom scrolling. Just what major institutions are actually doing with their money.